Picture a traditional investor, someone glued to a financial news network, reading through earnings reports, and relying on decades of intuition to pick the next big winner. But when there are sudden, unexpected market movements, that heavy reliance on human intuition quickly breaks down. Human biology is wired for survival, not high-frequency trading. In a high-stakes environment, cognitive biases like fear and greed turn intuition into a profound liability. Navigating modern markets requires an investment strategy that can function without the interference of human panic. This is the role of quantitative investing, the scientific approach built at the intersection of mathematics, finance, and computer code. The core objective of this shift is to replace human decision-making with a set of systematic algorithmic rules. To survive modern volatility, investors are moving away from the limitations of the gut feeling and toward the precision of engineering. Building this system starts with the first pillar of the pipeline, data collection. Since the machine lacks instinct, it requires massive amounts of raw information to serve as fuel. Quants look far beyond standard stock prices, ingesting what's known as alternative data, or alt data, to build a more granular picture of the world. While a traditional investor reads a news report on retail growth, an algorithm scans satellite imagery to count individual cars in a store's parking lot. But raw data is useless without a way to organize it. This brings us to the second pillar, model development. This formula is where the strategy takes shape. Quantitative models calculate the expected return of an asset based on specific weights assigned to different market variables. These models process the noise to isolate a winning edge, a mathematical advantage often invisible to the naked eye. The system seeks this edge by scanning for broad market behaviors, such as targeting historically undervalued assets or riding sudden waves of momentum. Other models hunt for microscopic, temporary price gaps between related assets, profiting from corrections that last only a fraction of a second. This processing phase turns a chaotic world of raw information into a hyper-focused mathematical prediction. Once that prediction is locked in, we reach the final pillar, execution. Because the data has been collected and the probabilities have been calculated, the actual act of buying and selling requires no human deliberation. Execution is entirely rules-based. The exact millisecond data hits the target parameters, the system triggers the trade, like mechanical gates snapping open in sequence. This stage leaves no room for hesitation or second-guessing. The system simply follows the logic it was programmed to execute. Quantitative execution represents the triumph of algorithmic logic over the volatility of human hesitation. It is important to clarify what this technology is not. Quantitative investing is not a crystal ball. Algorithms cannot predict the future with absolute certainty, and they do not win every single trade. Instead, the machine functions as a high-probability toolkit. It is designed to win a long-term war of attrition by relying on massive sample sizes. This chart shows how that works in practice. While red loss bars appear frequently, they are consistently outweighed by green profit bars. This slight mathematical edge, when applied to thousands of trades, builds a compounding upward trend over time. When your capital is on the line, who do you want steering the ship? Which do you prefer, human intuition or algorithmic logic? Let's discuss your choice in the comments below.